So, oil. To be honest, we rarely have as tumultuous, as volatile, as unpredictable a year that in oil markets that we had in 2022. So effectively, large chunks of the industry have expected that this year, 2023, would be much more normal, that there would be some form or shape of normalization, less volatility, more predictability, and kind of, people could foresee whatever is going on. And even though we still inherit some bits and pieces of 2022, think of just inventories, for instance, on the slides, as shown here, which are still 100 million barrels, oil inventories are still 100 million barrels below the 5-year average. We share the view that oil markets will become more normal, in a sense, in the upcoming year. And the return of China and effectively all sorts of Russian travails will be the two leading stories heading into 2023. I will develop on each of these stories as, within the progression of my presentation. Yet I want to highlight this very fact. Neither of these events is linear. Neither of these events will bring developments that just cause something to happen throughout the course of 2023. It will be very choppy, and choppy will be the buzzword of 2022 after arguably volatile being the buzzword of 2023. So think of refinery maintenance, an event which very often got delayed in 2022. We believe that refinery maintenance in the first half of 2023 will leave much more of an imprint on global crude balances. Effectively, higher refinery maintenances will keep the market significantly longer in the first half of 2023, leading to a very strong summer push. And at the same time, as this is happening, as these stories are developing, Russian production will be swinging from a very strong plunge into a correction, again, come the summer months. So add to this the overall easing of economic fears, because economic recession is still a story to be talked about, but as we move closer towards the end of 2023, it will subside. We think that effectively oil prices will be moving within the $80 to $90 per barrel bandwidth. Specifically, they will be following the trends of seasonality and the trends of Russian production being cut in Q1, Q2, and of Chinese demand gradually coming back into the markets over the course of this year. But let me start with the first big story, if one is to say, and that is Russia. So Russia, the key story arguably with Russia has been that exports are no longer territorially limited to specific countries. So for instance, the gradual pivot of Russian exports towards Asia has led to a situation whereby Asia does no longer buy the usual suspects like ESPO or SOCAL, but pretty much Asia buys all of Russian crude. And it has also led to a situation whereby India, a country which did not buy a single cargo of Russian oil in January 2022, has ended up being by far the largest buyer of Russian crude come January 2023, or for that matter, February 2023, which should see the highest number of imports on record. So effectively, the Asian pivot is happening, but what's going on in the background is a very shady picture of where Russian production is. And I've, one could say, deliberately not included the chart on Russian production because I want to guide you through it as we talk. But Russian production over the course of Q4 and even January 2023 has been at almost pre-war levels of 10.9 million barrels per day. This is crude plus condensate. So effectively, there is no plunge, there is no reaction, not even to the oil price cap as things happen. We don't think that this will be a longer-term story. We think that the product price cap is going to leave an imprint, but it's important to keep in mind that effectively Russian production did not plunge up until now, and now is the time to go down. We think that the upcoming production cut is going to be reflective of the difficulties that Russian exporters will be facing in marketing their products. Specifically, it's very difficult to place your produce into markets which are already saturated, as opposed to oil, where that transition, that pivot towards Asia, has been relatively smooth. Asia needs the oil. If you discount it, it's going to buy it. With products, it's going to be a little bit more difficult. The one thing that I would very much like to highlight is, where do you expect Russian oil exports? Because we expect Russian production to plunge to a new norm of 10.5 million barrels per day, so roughly 400,000 barrels per day lower than it used to be before the price cap. And one could think that Russian oil exports would go down with it. Now, creating a synthetic Urals balance, which you see here, actually leads us to believe that there will be more Urals in the markets, even though marginally than in 2022, but still more Russian oil in the markets. There are several reasons for this. First of all, whatever remains of Russian deliveries into Europe via pipeline is very much a fraction of what it used to be before. That oil needs to go somewhere. Now that Chinese state-owned refiners have been green-lighted to kind of buy Russian crude again, because ESPO and SOCAL have created a market of their own in Shandong, and in all companies private. But the state-owned refiners were very much wary of the geopolitical risk to go into that market. Right now, it seems to be off, and Urals buying of these companies is actually picking up. So you have two trends which kind of underpin the entire story of moving Russian oil into Asia, of those exports remaining strong and production falling in line with refined products and not the oil exports. So this is effectively covering the story of oil supply availability in the markets. We don't really expect that there will be an oil supply shrinking, but we do expect that with products it's going to be a little bit different, as Andon would tell you a little bit later on. So what about Europe? Seeing that basically there's no more Russian flows into Europe, probably with the exception of Bulgaria, which still receives which is exempted by the European Commission, and whatever remains of Druzhba flows, especially now that kind of Poland got cut off over the weekend. Let's look into European sourcing options, because that's a very interesting topic to look into. What did European refiners replace their usual Ural slates with? What is the new norm, in a sense? And European refiners have very much ramped up their imports from West Africa, from Latin America, from the United States even. But we think that the upside, which is distributed and allocated across those countries, will be uneven. Why? You might see on the chart on the right that the average European grade that's moving into Northwest Europe is getting lighter. In fact, the difference between how light Northwest European imported grades are and what their pre-war invasion levels were is effectively 1 degree API. So the Northwest European slate is getting lighter, and we think there's a natural limit towards how far it can go. Therefore, we believe that Latin American flows, and specifically Brazil and Guyana, are very much to be on the upside towards Europe, because they provide the quality that the European refiners need, even though if they are too expensive for the market, the medium availability, the medium density availability is something that the European market will be looking into because it doesn't want too much of an aftercut. Hence, the likes of Brazil and Guyana already picking up ever since the second half of 2022, and they are already picking up in 2023 as well, will be kind of natural areas of interest, providing that medium density quality that they like. Now, one interesting thing, and I wanted to highlight this with the chart on the left side, is specifically how European arbitrage is looking. Because one would think that as the situation, the global situation with the futures and the arbitrages between different regional benchmarks is kind of easing. And arbitrage is becoming the most profitable that it has been in the past 12 months at least. Then one would see more flows going from Europe into China. And I mean, we still have to remember that the likes of Johan Sverdrup, the main Norwegian export grade, at the time when they were introduced into the market, I mean, they mostly went to China. They were loaded onto VLCCs and there you go, into China. Right now, there's barely a cargo of North Sea production moving from Europe into China, even though the arbitrage is not open, but workable. And this is, again, a trend that we expect to continue, namely that whatever endemic production Europe has will most probably remain in Europe, as opposed to previous times when it was very much export-oriented. Now people care about sourcing more because they understand that there's a stretch on medium availability. And Johan Sverdrup fits that description perfectly. So whoever can lock it in is actually a very lucky entity. So let's focus on China. We've already covered the European front. Let's cover a little bit the Asian front as well. And I would argue that Asia is the biggest, that China is the biggest Asian story coming up. Almost half of incremental demand going into 2023 will be China. China will be growing strong. Effectively, the refinery capacity buildup that China has seen, to the extent that Chinese nominal refining capacity is already above the United States', will be, in a way, dictating that China moves towards a level where it utilizes its assets more. Effectively, there's 1 million barrels per day of additional capacity. This year alone, there's more than 500,000 additional capacity. There's no zero COVID policy. There's a very much policy guideline to be utilizing Chinese or domestic assets. So it is going to be definitely a story, but, and this is again a very important but, how will this pan out? How will this happen? Because technically we are already in this, well, I mean, February is almost over. We're 2 months into 2023. And where's that Chinese demand or import pickup? December was super strong, but after December went, we have January and February, which are kind of okayish, but nothing spectacular. And this kind of underpins the main issue with Chinese buying right now, because Chinese buying has become very opportunistic. Chinese buyers, be that state-owned refiners or private ones, go into specific markets that are relatively cheap, buy them up. We have seen this with the likes of Upper Zakum, where a well-known Chinese state-owned enterprise went into the market and bought 15 cargoes in January, February. We are seeing that right now developing with Russian cargoes as state-owned refiners are trying to get into the Urals loading program. We are seeing that, we will be seeing that with March, because in March there will be a massive uptick of US exports from the US Gulf Coast going into China. I mean, if we are to believe fixtures, fully fixed fixtures, so not canceled ones, at least a dozen VLCCs is moving from the United States into China. So this is going to be a big story, the opportunistic buying of Chinese companies. And in my personal opinion, and in our corporate view, the real sentiment about China coming back will only be felt in the summer. We are separated, what separates us from now and summer is the Chinese refinery maintenance season, which will be quite large, specifically into April and May. That again will leave an imprint, because many people who don't know that's happening will be thinking that something wrong is going on in China, that it's not buying enough. But the problem is that they have not delayed that maintenance. They will have that maintenance. And effectively from April, May onwards, when China will be buying into the summer, we will see the genuine impact of China coming back. So don't expect anything sensational. Don't expect a massive influx of crude. Expect a gradual ramp up into the levels that we expect. So, talking of Russia in general, talking of OPEC Plus and how it has been faring, let me guide you a little bit through our view on OPEC Plus's production, because one needs to highlight how effective OPEC Plus was. I mean, if one's overarching goal is to maintain palatable oil prices close to fiscal break-evens, and to maintain a level of predictability in the market about who's producing what and where it is going, then it's quite peculiar how the OPEC Plus sentiment has developed within the group itself. I mean, back in 2001, I was 12 years old, so I cannot really remember. But if I'm to, bone up book and see what has been going on, every single Russia-Saudi initiative was an absolute failure. It wasn't even a failure. It was a theater of cheating whereby stuff was getting railed to avoid supervision. Compare that now when you have a level of cohesion and communication that's basically unprecedented. And we believe that it's exactly this psychological or sentimental level that is hyper important. Why? Because this provides the countries that participate in the oil group with the trust to build this further. And we think it's going to happen. We actually think that OPEC Plus will outlive 2023, and the cohesion that's within the group will be one thing that underpins the market. Whatever happens, they will balance it. Think of it even from a reporting perspective. Before November 2022, the average compliance rate of OPEC Plus was 300%. It was massively under complying everything. Ever since the production target got changed, now they're at a nice, fine 150%. It even feels better to be participating in that group. However, there's one caveat to that. We don't really think that OPEC Plus will drive production growth in 2023. We think that as China comes back, there will be incremental supply coming from Saudi Arabia and the UAE. But very much the goal is to keep the levels and the prices which are palatable. They don't want to overdo the market. Seeing that China will be coming back, they want to keep the caution and bring back production when they are sure that it's going to stay. Which again leads me to the other story. Where would supply come from? We need to balance the more than 2 million barrels per day demand growth that we will be having this year with some supply. One could say that the US is the biggest source of supply increments, and it is true. The US will add 600,000 barrels per day, but the star of US supply growth is starting to decline. Provinces start to mature, plays start to get depleted, and these sweet spots are increasingly rarer. So where would we look? I mean, naturally, we would look to other potential non-OPEC countries, but it very much seems to be focused on one area. It's very much Guyana, which again hits discovery after discovery, and those discoveries come back basically as ExxonMobil has an FPSO, immediately they come in. And it seems to be Norway, which again is just a reflection of Johan Sverdrup coming in full, and Brazil. And this ties in with my last slide, which potentially might leave you a little bit of, sad and depressed, or very upbeat, depending on where your market stance is. And I've prepared a slide which might come across as a little bit chaotic, might come across as a visual demonstration of completely random things. But I think that the one overarching story that connects these charts, namely the lack of investment into drilling, is something that we need to talk about. Because it's a trend that's much larger than just national preferences. For instance, over the past 12 months, exploration in Russia has dropped massively. And Russia was always considered to be a country which is kind of stable in its drilling. Now it's no longer the case. They only invest in development drilling. Brazil, a country that back in 2008, at the peak of its drilling heights, was drilling 150 exploration wells, is right now drilling 15 or 20. You look into the drilling sort of masterminds of the Middle East. You look into Saudi Arabia or the United Arab Emirates or Iraq, and they are still almost half the level that they used to be before 2020, before the pandemics kicked in. And whilst the oil community kind of managed to pull off some real discoveries, just think about Namibia, Total's massive discovery with Venus. Think about Guyana, which continues to provide us with many opportunities. We should not let this overshadow a significantly larger trend that's developing right in front of our eyes. And I think that the insufficient investment into upstream is going to be a much bigger story in the longer term. And we need to focus on this as we head into the future, because if that is the case, and if we don't bring this production back, then we'll have prices higher for longer. I hope I didn't end my presentation on an emotional downer. So I would very much advise you to invest into oil stocks, because that's where the money is. That's where the future lies. Don't get depressed. Use that depression for something creative, and everything will be fine. So on this, thank you very much. And if you have